Hi, I'm Kristen King, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we're looking at the much vaunted idea of the reflation trade, rotating out of growth stocks and into value, and just what's involved. Most investors will be aware of the great run that growth stocks have enjoyed, not just over 2020 to date, but for several years before that. In fact, over 5 years, the NASDAQ 100 index, which is packed full of growth stocks, has risen by more than 205%. And if we look at the S&P 500 information technology sector, the poster child for growth stocks, we see that it has risen by 239.93% over the same time frame. According to Trackstar IQ, our proprietary search tracking tool, both SPY and QQQ, funds which track large cap growth equities, remain the two most researched ETFs by institutional investors by a wide margin. Value stocks, however, haven't fared so well over that time. Value stocks tend to be those of established businesses, often well-known brand names with a mature market share and not growing at any pace. Markets being what they are, these stocks are often overlooked as traders and investors prefer to seek out the next big thing. When this happens, the share prices of those stocks can slip away, eventually falling below key valuation benchmarks such as price to book, price to cash, price to sales, etc. At this point, their valuation looks low relative to both highly rated growth stocks and the market as a whole, hence the value name tag. We can think of value stocks as being asset-rich, but ratings poor. Value investing is all about spotting the stocks whose share prices are trading below their asset values and then buying those stocks in the expectation that the market will re-rate them or that they will be bid for and broken up. However, you've had to have had a very thick skin and a good deal of patience to have been a value enthusiast in recent times. If we look at the performance of the S&P US Value iShares ETF, we find that it has returned just 56.57% over the last 5 years, which in isolation doesn't sound too bad. But those numbers compare very poorly with the returns from growth stocks over that period. So why might now be the time to consider value stocks once more? One of the biggest drivers is the concept of the reflation of the US and global economies. Fans of the idea argue that reflation will be driven by a combination of further COVID stimulus, low interest rates, and a change of administration in the U.S. The Democrats are seen as likely to invest heavily in U.S. infrastructure in areas such as renewable energy, healthcare, and education. The reflation element comes from the belief that the extra spending and the investment this creates will boost demand in the economy. That, in turn, should stimulate growth and cause inflation as demand for goods and services outstrips their supply. In these circumstances, the prices of real assets rise, and these are exactly the type of assets that value stocks tend to own. The idea received a shot in the arm recently as news of the Pfizer COVID vaccine broke last week, and thoughts turned to reopening of the economy, which would also boost growth and inflation. Bank of America said on Friday that we may now have seen the top of the bond market and that last week saw the second biggest inflow of funds into U.S. equities ever, with $32.5 billion flooding into the stock market. However, that is just the tip of the iceberg, as money managers are currently sitting on $4.3 trillion of cash parked in money market funds. Right now, the reflation, or rotation trade, looks premature. Yes, we saw what it will look like when the vaccine news broke, and we may get another taste of that as and when a second stimulus package is approved and released. But with large-scale vaccination programs not likely to be up and running before late Q2 or perhaps Q3 2021, the status quo, i.e. the supremacy of growth stocks, is likely to be maintained for a while yet. But that, of course, leaves us plenty of time for some bargain hunting of our own. That's all we have time for today, folks. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. As always, make sure you do your own due diligence before making any investment decisions.